and as I like to say, to live in the black and not in the red, and be able to meet your expenses every single month. I remember a long time ago watching an old skit on a TV show where people were like in a certain financial management class. They're all waiting for a financial guru to come in, and he was going to teach them how a person can live without debt. So they were all waiting anxiously. The person walks in, and he says, "If you don't have the money for it, then don't buy it." And he walked out of the class. And that's really ultimately right. That's true, right? I mean, a person should only spend what they have money for, and extending yourself on credit is something that ultimately is going to come and bite you down the road. But obviously, we live in the real world, and today we're going to try to have some awareness of how a person can maintain financial management and not be in such a situation. I'm going to focus tonight on 4 main points. The first point, again, the main point again is credit and debt. But we have to take a step back and just to be able to understand how to get to that point where we can have manageable debt. I'm going to focus on 4 points. The first point I'm going to focus on is tracking. The person has to make sure that they know they have a calculation, a cheshbon, of whatever money comes in every month and how much money they spend every month. That's what if a person has income from a business, he has to have that recorded, and he has to have his expenses recorded so that his expenses don't exceed his income. That's the reason why most people fall in trouble is they don't do that tracking, they don't do that bookkeeping, and that's why they end up in trouble. So that's the first thing people need to focus on. Then I'll do proper tracking. Then I'll talk a few minutes on income supports. Sometimes someone will do a budget and see that they made, let's say a person makes $5,000 a month, for argument's sake, and their expenses are $5,500 a month, or whatever it is. So you're $500 short, 500 short. At the end of the year, you're talking $6,000, and divide that by 5 years, you'll be $30,000 in debt, right? So if you can somehow find a way to bridge that gap, that $500, so that you'll be basically in the black and make it month to month. The difference between being 5 years, $30,000 in debt, not having any debt at all. So there's some income supports I'll just mention, some that people know about. They're obvious ones, but some that people might not know about. Again, the whole point of this is just to point out how to be able to be financially solvent, so that if a person wants to be able to run a successful business or a successful company, he has the wherewithal to do it. The third thing we're going to talk about is debt, right? Everyone, we said before, that's what we're going to talk about, having manageable debt, right? So there's 2 types of debt. There's good debt and there's bad debt. Good debt is something that is looked upon favorably by the credit bureaus and by banks, because if you have good debt, that shows you have financial responsibility, and that you're trustworthy and you have integrity, and investors will want to invest with you, because the debt that you have is what's called good debt. We'll soon describe what that is. And then there's bad debt, which is really another word for credit cards, I like to say, which is bad debt, which basically they have, once someone gets in that cycle of just putting money on credit cards and paying high interest rates, it's basically a never-ending cycle of just falling into a dark hole of paying endless interest without any light at the end of the tunnel, because you're in a position where you can only make the minimum payments. And that's something that's considered bad debt that makes it basically unbankable. So in terms of running a business, especially if you're a startup looking to start up money, it's going to be very hard for someone to be able to put together money to be able to run a business when a person's financial situation is so bad in that situation. So, and the last thing we're going to talk about is credit. And that credit, I think, is something that, again, someone who has poor credit or below average credit, again, that makes you unbankable. A bank is not going to look at you, an investor is not going to look at you if you have poor credit. So there are ways that a person can monitor their credit reports and always maintain, even with debt, and always maintain an above average credit score. So we'll talk about we'll talk about what the credit bureaus look for and how a person can, I guess you can say, navigate the system to be able to maintain above average credit score, even if a person has debt. Those are the 4 things. Let's talk about, first of all, tracking, right? So as we said, the most important thing is that a person, whatever income is coming in, a person should make sure that they know what money is coming in every month and what money is going out. As long as you budget that properly, That right away puts you on the correct footing, because the most times people get in trouble is because they don't really know. I have people all the time come to me. They say the business is doing well, and they don't know why they're losing money, and that's all due to poor record keeping and bookkeeping. If a person really needs to make sure that they track the money that comes in and comes out, that's the most important thing. So let me just list a few mistakes people make. Also, in terms of just personal finances, I find important mistakes people make when they are tracking and when they're doing their budget, making sure they have enough money. Mistakes people make in terms of budgeting. One is getting a big tax refund. Again, we're going to talk a little more on a personal level. We'll get to business soon, but I know a lot of people who I deal with that at the end of when it comes time to tax season, they get a big tax refund, right? Because they took too many withholdings at the end of the year, and it's great, right? At the end of the year, they have $5,000. They can, they a new business. They can, they pay off creditors. They can, or whatever it is. If it's personal, they can send their kids to camp or whatever it is. But so that's a good thing, right? They're getting $5,000 because they took too many withholdings they withheld too much or too much taxes. So the answer is that's incorrect. Basically, what you did is that you gave an interest-free loan to the U.S. government. Instead of getting the $5,000 one lump payment at the end of by tax season once a year, basically you could have had an extra $400 a month in your bank account that could have helped you bridge the gap between making it or not making it. Right? If you had that extra $400 a month in your bank account, that's something that could have helped you. So if you are an employee, make sure that you take the right amount of dependents, you take the right amount of withholdings, that you pay the right amount of taxes. So at the end of the year, even though you won't be getting that big lump payment, but you'll be able to have a few extra dollars in your bank account every month to be able to meet your expenses. Another big mistake people make is not planning for big expenses. Right? Someone knows, especially in their business, at certain times of year that they'll be spending more money, or in their personal life, big times of year where they spend more money. So a person in their budget should plan for that. Let's say just in terms of personal, Pesach time, whatever it is, Sukkot time, people have large expenses. Let's say they're going to spend $5,000 on that. Let's say around Pesach time, they know they spend on clothing or whatever it is. So in your budget, you make sure you put away $200 a month towards that big expense that is coming. So it doesn't leave you. Comes time to the big times of the year where in terms of your business, having to buy inventory, making a large purchase, or in terms of personal, and then having to lay out money on a credit card or taking out a loan, a high interest loan. If you just budget properly, you'll be able to have enough money when that time comes. And another mistake is not having a savings plan, or not saving for sometimes people have these unexpected expenses, especially in their business. Something comes up. They have a big order. They have to be able to fill it, and they don't have the money to fill the order, or anything in their personal life. So again, part of financial management is budgeting for unexpected expenses that may come up, or times that you need money. So if you're able to put away money every month for unexpected expenses, so that will leave you in a better financial state. Again, the point here being, as we said, is in the tracking, is that a person shouldn't have debt, and that every month you should be able to live month to month. These are just some ways that a person can figure out how to budget themselves properly, be able to be in a position where they can be solvent, be in the black every month. Okay, so let's just talk about now. Okay, so now you did your budget, and now let me just talk about a few income supports that, again, some of these are quite obvious, people know about. Again, this is in terms of just regular financial management. We're almost up to debt and credit. I just want to talk about a few income supports that people might not know about. I'm going to list all of them. Some of them are quite obvious to people, obviously. But if someone, let's say, makes $10,000 a month and he's spending $11,000, as we said, at the end of the year, you're $12,000 in debt. And then after 5 years, you're $60,000 in debt. If you find a way to bridge that gap and get that extra $1,000 a month in your bank account, and you'll be making $10,000 and spending $10,000. So this is a way that, again, it's the difference between having great credit and being bankable and being able to obtain money for your business, or it's a difference of you being heavily in debt and not being bankable at all. Let me just list a few income supports. Some of them are based more for personal. But let's just go through all of them. One is obviously benefits. If you're eligible for it, right? The food stamps, WIC, Child Health Plus. Child Health Plus is a very big thing people don't know about. People know about the insurance, Child Health Plus, but basically people don't know the income requirements. People can be making up to $200,000 a year and still be eligible for Child Health Plus, which is basically either no cost or very, very low cost insurance for your children, and that could save you hundreds of dollars a month. And again, to bridge your gap with doing your budget, to help you bridge the gap. Another thing is employee benefits. Someone is an employee somewhere. There are plenty of employee benefits out there that an employer can give you. There are something called like a flex spending plan, where a person, let's say, has $1,000 worth of medical expenses a month. Your employee, if he offers it, find out if your employer offers it, they can basically offer you this flex spending plan where the $1,000 will be tax deductible. It's a tax write-off. So that will go off your income and you won't have to pay taxes on that $1,000. Right there is a $200, $300 saving. Some people who work in the education field, I know I have a few clients that are in education. So people don't know about this, something called QTR, which is called Qualified Tuition Reimbursement, where basically the employer can pay your child's tuition right off and will be a direct write-off. So in other words, if, let's say a person makes $10,000 a month, your employer can pay your child's tuition. Let's say your child's tuition is $3,000 a month. And basically you'll be paying, you'll be getting income. Instead of $10,000 a month, you'll be getting income, you'll be getting a check for $7,000 because your boss is paying the $3,000 for insurance. So what's the difference between paying taxes on $10,000 and $7,000? It's $3,000. That could be close to $1,000 a month. So anybody who would be eligible for that, it's a great benefit. It's called QTR. If someone has a spouse or is in education and is in that situation, another way to bridge the gap can save you hundreds of dollars a month to be able to, again, to meet your monthly expenses. There's something called the EITC, the Earned Income Tax Credit. People are eligible at the end of every tax season. There's a certain credit people get for when they file for their taxes. If they're eligible, they'll get income. They'll be getting something called the Earned Income Tax Credit. It could be $5,000-$6,000 at the end of the year. But people don't know that they can get that money paid to them every month. They can speak to their accountant and set it up. So instead of getting that one lump payment of $5,000 at the end of the year, they can get $400 a month. Again, that can help them meet their monthly expenses. So that's also very important. Another thing is a mortgage. Someone owns a home and is paying whatever percentage, 5-6%. There's always the option to refinance or do a loan modification. If you can lower, right now the rates are probably about high 4s now, or even 5. If you're paying a much higher interest rate, then you have an option to refinance. You're right, it could be in the long term, you'll be paying more because you're starting again your mortgage, and over the length of the mortgage, you'll probably be paying more money. But month to month, you'll be saving a few $100s. And again, the point again is to make it financially solvent. So it's a difference of you being in the red or making it month to month. It's much more important for you at this point to be able to meet your monthly expenses than to worry about how much money you're paying down the road. So again, if you have the option to refinance or do a loan modification on your mortgage and save you a few $100, if you're just short a few $100, that could be something that would be worthwhile for you to do. Just as an aside, I happen to work in Cultural Flatbush. I help people with home buying and home ownership. There are a lot of programs out there for first-time home buyers, a lot of money out there. You could be getting up to $50,000 in government grants and city grants and state grants. So if anybody wants to talk about it, someone is in the market for a home or whatever it is and wants to talk about what's out there for first-time home buyers, they basically can get in contact. Another thing to way to bridge the gap is balance billing. Again, something seems obvious, right? But not everybody takes advantage of that. During the winter months, people pay a fortune on gas bills. During the summer months, people pay a fortune on electric bills, on air conditioning. Instead of getting a $500 bill in the summer for your electric bill, it makes sense to call up your utility company, get them to make a balance billing. Basically, you'll pay the same amount every month, and they'll help in two ways. First of all, it'll help you be able to know every month, work out a budget, know exactly how much money you're spending on. Again, it could be your company, it could be your personal. If you have money coming in, if you know exactly how much money you're gonna have on your electric bill, instead of all of a sudden coming up with a $500 bill because of it was 90 degrees all week, you know you're paying the same set amount. It's much easier to budget, and you'll save yourself $200 a month. This is something that obviously it has to work for you, but sometimes if you're an employee, you can ask for if you're comfortable with it. If you do a budget and you realize that you're, let's say, $300 short, as I keep on saying over and over again, if you're $300 short a month, give it time, over a few years, you're going to be thousands and thousands of dollars in debt. So if you can speak to your boss, if you see that let's say you're $300 short, and you need that shortfall, which is $300 a month, what is that? That's about $3,500 for the year. So if the person is comfortable and go to their boss and say, listen, the difference between me being financially solvent, being financially capable, being bankable, and not being in debt is the whole thing is $3,000 a year. If you can raise me $3,000, it would be a huge help. I would be able to make it month to month. Again, everyone has to know that situation, see if that's possible. That is definitely something that is something that someone should be looked at. It's not a lot, in a situation where it's not a lot of money and it's not a great big ask. Everyone should look at that as an opportunity. People want to, when they go in to ask for a raise for their boss, they want to have a good reason to be able to go in to ask. So, obviously doing a good job is the most important part, but if someone can show them that this is going to be a difference in meeting my monthly payments or not, if you have an understanding, caring boss, it might work. You never know. Something that I always recommend to my clients. Basically, another thing that people can do to manage their money is I'm able to try to meet their expenses. It's just basically making your house more energy efficient. I just did a little construction on my house. I got new windows. I insulated. I'm saving hundreds of dollars a month on heating bills. You'll be surprised how much you can save on that. So again, these are basic things. Turn off lights. Replace your lighting with LED bulbs. Try to get energy efficient appliances. All these things can save you hundreds of dollars a month. Another thing that's quite obvious, we said, are impulse buys. Someone, in the habit of, it could be in your business, it could be in your personal life. Sometimes the person just buys things for their business without thought, just because, they think it'll be good, without doing the proper research. All the financial counsels always tell you, before you make an impulse buy, take 24 hours to think about it. If you still feel that you need that product, or you need to buy that, after 24 hours, then buy it. But again, impulse buys, again, what causes people to go into debt, because they're just buying and without thinking, and it ends up costing them down the road. So again, these are the type of things you should look at in terms of impulse buying. Pet peeve of mine is life insurance, right? Obviously, everyone is supposed to have life insurance as a protection for your family, right? God forbid, worst case scenario. But my pet peeve of people is that I tell people life insurance is not an investment, right? It's not, if the person has money, go ahead and invest, obviously. But to get a whole life plan and use your life insurance as an investment, that's not what life insurance is about. Life insurance is a safety net. It's supposed to protect your family in case of an emergency. So you can get term life plans a few $100s a year. So forget about the whole life plans. If it's something, down the road, if someone has money to invest, then go ahead. But again, if you're struggling to make it month to month, people are convincing you to get a life insurance policy. It's the greatest. The whole life policy is investment. You're going to make money with it. The point of the life insurance is not for you to make money with it. It's to protect your family. So stay with the term plan that could save you. If you have a whole life plan, switch out of it, in my opinion, and be able to stay and pay just a few $100s a month, again, as a safety net for your family. This is something, again, this is not really a month. This is just another basic spending tip in terms of mortgage. People have a mortgage. I don't know if people know about it, but if they can make one extra payment a year, that will basically save them 8 years on their mortgage, which is hundreds of thousands of dollars of interest. So if the person has that capability, he has that extra money. Again, this is not really helping you in your monthly budget, but this is something that person should do in terms of if he has the mortgage on a business or on his personal. If you can make that one extra payment, that can save you hundreds of thousands of dollars down the road. It's something that a person should be able to do. And then the last thing is just your day-to-day life, right? This is again, I'm not here to judge anybody, tell anybody what to do, but getting that Starbucks coffee instead of making a coffee in your house, getting sushi for lunch instead of brown bagging it from home. These are things that also could save you hundreds of dollars a month. And if you're having a problem with just a few $100s, between meeting your expenses and being in debt, this is something that a person, like any other diet, right? A person should monitor themselves and see what they need, what they don't need. And this is something that can help them bridge the gap. So these are all things that, again, like I said, the main point of financial management is just basically a basic overview of staying within that. Like I said, the goal would be that whatever money comes in, you should track it, track the expense, track your income, track your expenses. And if you have a shortfall, try to utilize some of these income supports. The goal is to be every month to be able to meet and not have any debt possible, and therefore it will make you bankable in the future or your future business endeavors. Okay, so let's talk a little bit about debt. So again, if anybody has any questions, just take a step back, and if anybody has any questions on what we spoke about before, my contact information, someone asked me about my contact information. You can call me on my cell phone. It's 917-755-6470, 917-755-6470. You can call me at any time. I'll get back to you. So that's just one question. Another question someone asked is typical in life insurance. How long should a person struggling? How long should they have life insurance? So I think the answer to that question is everyone maybe makes their own decision, but at least if you have children, until your children are married off. I think that would be the correct answer. Everyone knows weddings are expensive. Once all your children are married off and you're having issues then with making life insurance payments, I think at that point it could be safe to hold back. Okay, so let's talk a little bit about debt. So again, debt, we said, obviously, really the main goal would be to be debt-free. But that being said, there's something called good debt, which basically shows financial responsibility. It shows that you're a capable person of managing money, and the credit bureaus and the banks look at it in a positive light, and it's good for your long-term financial health. And then there's something called bad, which is bad debt, which are things that are depreciating in value, are here today, gone tomorrow, high interest rates, and end up, in such a case, the banks look at it very negatively, and it leaves you vulnerable to not being financially healthy, to be able to get, to get money for anything, business, investors, to be able to buy a house, lease a car, whatever it is. All these things are not available to you when you have bad debt. So let's first talk about what is good debt and what is bad debt. And then we'll talk about how we can go about getting rid of the bad debt. So again, so what is considered good debt? So basically good debt, it's really 4 components, right? And if you have all 4 components, that's really if you hit on all 4, that's something that's great, and that the banks look at that positively and won't affect your credit score. The first thing is it's an investment for your future, right? So even though you're spending money now, but down the road, this is going to be something that's going to be worth more. So it's an investment. Again, so the banks look at it and the credit bureaus look at it, even though you're spending the money, but this is an investment for your future. That's the first thing. The second component is that it's something that's going to go up in value, increase in value. So again, it's the same type of thing. So you're buying it, you're spending money, but credit bureaus look at it that it's something that, a good example would be a house, right? You buy it now, and then down the road it's going to be worth a lot more. That's something that the banks and the credit bureaus look at it as also good debt. Third thing is low interest rates. So you're only paying a few percentage points of interest. That's also considered good debt. And the last thing is long-term repayment plans. That again, mortgage, for example, you have 30 years to be able to pay back the mortgage, pay back the loan. So those are the 4 components of good debt. So what are some examples? As I mentioned, for a mortgage, right? Mortgage really it's an 04. It's an investment for the future, right? A house that your family could live in. In most cases, it appreciates in value, it goes up in value. This has long-term repayment. Like I said, you can get up today up to a 40-year mortgage. And technically, usually its interest rates are fairly low. Now they're in anywhere from 4 to 6%. So that's mortgage is considered good debt and has really no negative impact on your credit score. In that same vein, a home equity HELOC, a home equity line of credit, which is the second lien on your house, also is considered good debt for the same reasons. It has, again, most people use the home equity to do home improvements in their house. So it's an investment for your future. It's your house is now worth more because you put money into the house. You have long-term repayment. The first 10 years of a HELOC, you only pay interest at the prime rate. And then after that, it rolls into a regular mortgage. So again, it's low percentage. Like I say, you have long-term payments again. So HELOC and mortgages are considered good debt on your credit. Another example is a student loan. Someone takes out a student loan. It's an investment for your future, right? You become a lawyer, a doctor. So even though you're spending money now, it's an investment for your future. It's, again, it's something that has low interest rates. In a lot of cases, you can get forbearance. You don't have to even make the payments for a few years until you start working. So that's another, again, long-term repayment plans. Student loans you do have to be careful about because sometimes down the road, they can get very aggressive in trying to get back the money they lend if the person doesn't pay back. But in the case of what a bank looks at and what a credit bureau looks at it, it's considered good debt. I forgot to mention in terms of a mortgage, besides for all the good debt, what the banks look at also that you're building equity. Every time you make a mortgage payment, you're gaining equity in the house. So for a business, for your personal home, your money is every dollar you put in to the mortgage, you're building equity for yourself. That's something that's considered good debt. A car lease, people consider good debt also. It's something that the item won't appreciate in value because you give back the car after 2 years. Most cases, it's long-term, it's low interest rates. So that's considered good debt also, according to the credit bureaus. And business loans also considered good debt. Someone wants to take out a business loan for their business. So again, so it's investment for the future because you're taking out money to be able to run your business properly. Again, obviously, the point is to stay away from the high interest lenders. There are a few organizations out there. One of them is obviously EPI, Hebrew Free Loan Society. Hebrew Free Loan Society and EPI, that they are also, they do interest-free loans. So, that's nothing better than obviously interest-free, right? That's something so these are examples of good debt. I'm sorry, someone just wrote that having trouble hearing me. If anybody else wants to write in and let me know. I'll try to talk a little bit louder. Not sure why that would be. If anybody anybody else, let me know if you're having trouble hearing me. Okay, so those are, like I said, so those are the 4 components of good debt. Okay, so let's go into now bad debt. Okay, so now someone has wrote that they hear me clearly. So, okay, so hopefully maybe I'll try to speak a drop louder. My voice is naturally in the lower octane, so I'm trying to be a little higher. So what's bad debt? So bad debt is basically, we just mentioned the 4 components. Bad debt is the exact opposite of the 4 components. Like I said before, bad debt really, I would say, are credit cards. Credit cards really are because those, let's look at the 4 components and they're exact opposite. We said one is an investment for your future. Credit cards are not an investment for your future. Most people that get, okay, another person said they hear me. Okay, so I feel that I'm good. Sorry, I'm a little distracted by the chat. Yeah, so bad debt we said are credit cards because the 4 components are It's direct opposite of the four components, what we consider good debt. We said investment for the future. People who have credit cards are for people that need day-to-day expenses. People use it for vacations. People use it to buy assets, things that are here today and gone tomorrow. These are all non-investments for the future. They're things that are things that you need for the here and now. Like I said, here today, gone tomorrow. They're usually the items that depreciate in value, things that you buy on credit cards. In most cases, they don't last. They're meant to buy for the day-to-day. Like as we said, people use it for their day-to-day life and for assets so that whatever they buy, appliances or whatever they use their money for, food, and it's here today, gone tomorrow. So that's another direct opposite of one of the components that we mentioned before. Most cases that they're high interest, right? You can get credit cards can be anywhere from 15% to 30%. And so we'll talk about different types of credit cards in a minute. But credit cards also, one of the components is low interest rates for good debt, but credit cards have high interest rates. And they're not long-term repayment. Most of the time, you have to pay them immediately month to month. If not, you get compounded interest. So credit cards really are the worst possible thing, and that causes people to be not bankable. So really the goal is when a person has debt is to only have good debt and not have bad debt. I know it's easier said than done. And it's really not in the class, we can't get through everything of what to do, but I am a debt counselor. So let me just mention the two types of credit cards that people get, and then I'll say what we can do about it. And again, people can contact me after, and we can get more into the nitty-gritty of it, how to actually get rid of this bad debt. As I said, the good debt is fine. It doesn't reflect negatively on the credit reports. Banks look at it positively. It shows financial responsibility. But credit cards are an issue. And there are two types of credit cards people get. The one type of credit card people get are they sign up because they offer great benefits, right? Let's say you can sign up. They give you get all these notices in the mail. You sign up. You get 100,000 free points for signing up. You get great rewards that they offer. So people rush to sign up for these cards. They need the money anyway, and why not? You might as well get the points and then the other perks that they offer. The problem is that these type of cards, usually you have to pay the monthly bill with interest immediately that month. And you have to make sure if you get such a card, you can make that payment. If the card like that is going to be 24% interest, and you spend $5,000 and you can't make that payment, you'll be paying hundreds of dollars in interest. And then what's it worth the points and the vacation and 100,000 points if you're just putting that money right back into spending it on the interest rates of that particular card. So that's something that, again, if a person is going to open that type of card, you have to be very, very careful that you can make the full monthly payment every month. Otherwise, you make the minimum payments, it's going to kill you. You're going to have hundreds and hundreds, if not thousands of dollars in debt. It's good that you'll have that free night in a hotel somewhere, but ultimately it's going to end up costing you. So you must make sure if you get a card like that, you must make sure you can make the full monthly payment. The other credit card people get is people need money, and you get all the time in the mail, or you see online. People get these advertising. No APR for 2 years, for 18 months, for 24 months. Right? And that sounds great. I need $10,000 for this particular purchase for whatever it is. So I don't have to worry about it for 2 years. I just have to make the minimum payments for 2 years. So they'll sign up to the card. They'll only make the minimum payments. So after that, the 2 years are up. They still have that same $10,000 principal that they owe on the card, and they can't pay it. So what do? They do a balance transfer. They transfer it over to another card. So now they have $10,000 on another card for another 2 years, making all their minimum payments. Basically, they're treading water. They're only making minimum payments every month. And the cycle continues month to month, and I see clients all the time. Before they know it, they're hundreds of thousands of dollars in debt. No light at the end of the tunnel because they're not making any principal payments, only paying interest payments. And this is something that kills you. Like the credit bureaus hate this type of debt. It's going to make your score extremely low and make you not bankable. So if you have this type of debt, it's imperative that you get out of this debt. This is something that you have to ultimately, at some point you have to rip off the Band-Aid and get rid of it. But this is something as a financial counselor I can help you with. I work mainly two types of ways that I help people who are in this type of bad credit card cycle, either through debt consolidation or debt settlement. Debt consolidation is basically taking all the cards and working with the credit card companies to make them one or two cards with one low interest rate. Again, that will affect your credit for the time being, but at least this way, there's a light at the end of the tunnel, and you'll be able to basically every month pay off principal, and at the end of 2-3 years, you'll be debt free. You'll be out from under that crushing yoke of feeling being choked and not knowing why you can do again, because that's the worst feeling, just making minimum payments and having a crazy amount of debt. So I work either with debt consolidation or debt settlement. Debt settlement is something that affects your card even more because you're not making the full payment. Basically, I can work with the credit card companies in some cases to make you pay only 40 to 50 cents on the dollar. But again, at the end of 2-3 years, you'll be debt free. And then as long as you followed all the other things you mentioned up to this point, and stay, again, because you're going to fall right back into the same rut and be in debt again, the whole thing is not worth it. But again, if your person is really mindful of getting out of debt, it's something that I can help with. If you have this type of bad debt, you can reach out to me. I gave you my number before, and we can try to see if we can get you out of it. And but just to reiterating that point, that if you do this and you are going to do this consolidation or settlement, you have to make sure that you budget properly, do proper financial management, that you don't end up in the same situation, because then the whole thing is going to start again. It's not worth it. So, but I do think, in my opinion, it is important to, as I said, rip the Band-Aid off. A person, especially if you're young and you have a whole future ahead of you, well, why should you be why should you have a crazy crushing debt and just build more and not know how to deal with it? Get rid of it, work with a counselor to get rid of it, and then start fresh. That would be my opinion. Okay, so any questions? If anybody has any questions, we can answer that. Like I said before, I'll give you my number again at the end of the class, and we can talk about, if anybody wants to reach out to me personally. Okay, as I said before, it's imperative that a person maintains an above-average credit score, because that's really your financial lifeline. That's something that's going to be able to make you bankable. If you're in business, you need a business loan, you want to invest, you need someone to invest with you, or whatever it is a person needs to do. You need to lease a car, you need to, any money that a person needs to have available, it's totally reliant on you having good credit. You need a mortgage, HELOC, all these things are only available to you is if you have good credit. And the good news is that a person can have debt, even bad debt, and still be in a position where he has good credit. It's just a matter of monitoring your debt and making sure that if you monitor your debt, you do it in a way that we'll talk about exactly what the credit bureaus look at. So once we look at what they look at, we'll be able to see if there's a way that you can navigate it to maintain good debt, even if you're in a position that you have high debt, you'll still be able to have an above average credit score. All right. Just 1 second. Someone asked, why would someone want to give you a consolidated debt loan if your credit is so bad? The reason why they would want to do it is because they want some money back, right? If the person is not really, if someone has $100,000 in debt and someone is not making the payments, the bank, the credit card company rather get $50,000 and get nothing at all. So that's why they're willing again, there are ways to do it, the way to talk to them, but that's why they would consolidate, because they rather get something than get nothing. Okay. So back to the credit. So we said that, how important it is to have an above average credit score. And we said it is possible to do that with having bad debt. First, let's talk about why it's important to have an above average score. As we said before, you want to apply for a mortgage, or you want to refinance with a bad credit score. It's going to be impossible to do it. Even if you have fair credit, the mortgage company will still give you a mortgage with 1 or 2 points higher than the average normal rate. and be paying hundreds, if not thousands of dollars at the end of the life of the mortgage just by having a bad credit score. Just for a mortgage alone, it's worth it for you to have an above average credit score. And even if you're not a homeowner, if you're landlords, right? If your business is looking to lease a space for your business, in a lot of cases today, landlords are looking at the tenant's credit report to see what their credit is. Because, again, a good credit report shows financial responsibility. So why would a landlord want a tenant that has a bad report that shows he does not have financial responsibility? So in a lot of cases, landlords are looking at the tenant's credit score. So for that, you want to be able to lease, you must make sure you maintain good credit. Jobs, you want to apply for a job. Again, a lot of cases today, employers are looking at employees' credit reports for the same reason. A good credit report shows integrity, shows financial responsibility. So these are all things that an employer is going to look at to make sure that their employee is someone trustworthy. So that's another reason why they'll check your reports, why it's imperative to have a good score. Any business loan, a person wants to apply for a business loan, want an investor to invest with you. These options are not open if someone has a poor score. Why would, and you want to show an investor that wants to invest in your business, needs to see that you're a reliable person, someone who has defaults and judgments and a credit score of in the 400s or 500s. Why would someone, even if it's personal, why would someone want to get involved with something like that? So again, another reason why someone should be very careful with that. So again, let's talk about, first of all, what is the difference in a credit report and a credit score? Let me take 1 second. Someone asked, how long does it take to get a good score if they have to settle their debt? Again, it varies depending on how much debt they have. The maximum, I would say, is 5 years. In most cases, it's anywhere from 18 months to 3 years, depending on how bad how bad the situation is. In most cases, 90% is between 18 months and 3 years. Okay, so let's just back up a second. What's the difference between a credit report and a credit score? So a credit report basically is the financial summary of all your financial payments over the years. Right? So it's a record of all your payments that you made, credit cards, everything and any financial transaction, that's going to be on a credit report. And the credit score is a numerical value that they place on the report. So how do they calculate it? So this is how they calculate it. I'll give you the breakdown. First of all, let me just say what's considered, I'm sure people know, but let me just go quickly. Why you should strive for. 300 to 580 is considered very poor, completely not bankable. 580 to 670 is considered a fair score. That's, in some cases, they'll give you maybe a mortgage with a crazy high interest rate, if you're anywhere from 580 to 670. 670 to 740 is where you recommend most people fall into. That's considered good credit. In most cases, that makes you bankable. 740 to 800 is considered very good credit, and 800 to 850 is considered great credit. So, so that's basically the numerical value. Someone asked me, can I help fixing credit? Yes, I can. We'll talk about that. Again, you can contact me afterwards. I'm going to mention something about this also as the class goes on. Okay, so now how does the credit bureau judge your credit report? So there's 5 components that they use to judge. And I'll do it in the order of importance. The first thing that they look at is payment history. Basically, all your payments that you made over the years. Did you pay them on time? Did you pay them late? Did you not pay them? Are there defaults? Are there judgments? So that's 35% of your credit score. So that's a large amount. So that's the first thing they look at. Another thing they look at is the amount owed. Your overall balance of what you owe to credit cards or whatever it is. Like I said, good debt they don't look at mortgages and HELOCs the same way. But personal debt, if you have large amounts, the amount owed, that's 30% of what they consider, of what they look at when they judge your credit score. Just as an aside, lenders look at it as a debt-to-income ratio. So let's say you're looking at a lender, let's say for a business loan, and you make, let's say, $100,000 a year, they want to see that your debt-to-income ratio is under the 35%. So if you, let's say, make $100,000 a year, they want to see that your amount owed on your credit report is under $35,000. If it's over $35,000, that's a big negative. So those are the first two. Credit history, very important, right? The third thing they judge is how long you have credit. And I always tell people that no credit is as bad as bad credit, because if the bank doesn't know, or an investor doesn't know if you have financial responsibility, that's just as bad as showing that you have that you have bad responsibility. You don't have responsibility. So it's imperative that a person, maintain a credit history. That's the third thing they look at. That's 15% judged on the credit when they judge your credit. New credit is 10%. If somebody opens up a bunch of cards, let's say a person needs money desperately and quickly, or he wants to sign up for all these rewards, these points, he opens up 5 cards in a short period of time. That reflects negatively on your credit report. It shows someone is desperate for money. That's also something that reflects negatively, and that's 10% of your credit report. And the last thing is inquiries. The 2 types of inquiries is a hard inquiry and a soft inquiry. Soft inquiries are when, like I said before, a landlord will call, finding out about a tenant. If an employer will call, finding out an employee, those are soft inquiries. They just check your credit report for that, and they won't really affect your credit at all. But a hard inquiry is when the person applies for a loan or a credit card, and then they do a hard pull on the credit. That's called a hard inquiry. That reflects 10% on your credit score. And so now that you know the 5 different components they use, we can take a look at each of the 5 components and see how you can navigate in a way that you can still, like I said, even with debt, navigate in a way that you remain with an above average score. One more thing I didn't mention, another thing that's a very, very big red flag for credit card companies is when you max out your credit limit. So if you have, let's say, a $20,000 credit limit, they want you to be under 40% balance on the credit card to what the limit is. Let's just make it easy. If it's let's say it's $10,000 credit limit, they don't want you spending more than $4,000 on the credit report. Anything over $4,000, you're over 40%. And the worst you get, if you're at 90%, if you have a $10,000 line of credit limit and you're at $9,000, that reflects very negatively on your credit report. Again, so I'm going to talk about how we can navigate that to remove that issue. Okay, so I don't know if people know how they can get that credit. Like I said, so now you see why it's important to monitor your credit report, and and if you monitor it, as I said, you look at these 5 components, and you can navigate in a way that you can maintain an above average score. So how do you get your credit reports? Everyone's entitled to 1 free credit report a year. You go to annualcreditreport.com, and if you didn't get it yet this year, you can get 1 credit report a year. If you already got it and you want to monitor on a continuing basis, there are websites out there. Credit Karma is one, Credit Sesame. You pay $30, I think, to obtain your credit report. There are ways to navigate it. You cancel your subscription within 30 days and get your money back. But you can get it from any time you want with paying, a fee. As I said, that's a small price to pay for the person to be able to monitor their score. So what is, again, so let's go about, how do you go about fixing it? Let's look at the 5 components, and after this will end, we'll talk about the 5 components and how we can, making sure to navigate in a way that these things won't be issues. So the first thing we said was payment history, right? All the amounts of payments you made. Again, so with late payments, that's something that won't be so easy to navigate because the payments are late. What can you do about it? But someone has unpaid debt, they have judgments, they have defaults. These things kill your credit score. As we said, it's 35% of your credit score, and it's imperative that you remove them, that you get these judgments and defaults off. Look at your credit report, see what you have. In a lot of cases, I work with clients all the time. There are mistakes. I had a client a few weeks ago came in and said, "Listen, here's my credit report. I have a judgment here on some Edisonville. It's not my bill. It's not. I never had this bill. It's not my account." And it was one email to when he opened up a dispute. Within 2 weeks, by the next cycle, his score jumped up 18 points. So again, people don't monitor their report. They don't know what's in there. There could be plenty of mistakes on it. But even if there aren't mistakes, if you have, sometimes A non-payment could be a $30. I had a client that credit was ruined and they paid hundreds of thousands of dollars of interest because they had an unpaid AT&T phone bill for $27. Since it was a default and a judgment, they couldn't get a perfect score, and they had to pay a high percentage on their mortgage. Over 30 years, what is that? So for a $27 AT&T bill, he's paying thousands and thousands of dollars. So, if you look at your credit report and you see a $27 AT&T bill, pay it. Get that off, get the judgments off, and look for mistakes. As someone mentioned before, there are ways, even if these defaults are real and a person can't pay it, there are experts out there. I can help you find the right person. There are credit experts that can remove these judgments and non-payments off your credit score, off your credit report. They charge for it. In some cases, it could be expensive, but in the long term, the average price, depending on how many judgments, the normal going rate, I think, is about $500 a judgment to have removed. For most of these people, maybe we can get a little cheaper, but this is something that, like I said, you want to be bankable and financially solvent, be able to be down the road, be able to do business properly. It's imperative that you go about fixing payment history. Next thing we said is the amount owed, right? We said the lenders look at the debt to income ratio. So let's say you make $100,000 a year and your amount owed is $37,000. If you find a way to pay $3,000, get yourself under the $35,000 threshold, that, so again, it's a way to play the system a little bit. That you're maintaining under 35%, and that could raise your score by a few points. And that will make a lender more interested in lending, seeing that your debt to income ratio is less than 35%. So again, so it's just a matter of looking at your report and monitoring it. And again, maybe something that could be fixed. The third thing we said people look at is credit history, right? We said that credit history is something that, you're looking, that's going to affect your credit if you don't have any history or very little history. So no credit is bad credit. So if you have an opportunity to be able to open up a card, a lot of banks offer for $200-300, you can open up a card and start and make those payments every month and build a credit history. That's 10% on your credit report. We said new credit, right? We said opening up a bunch of cards is something that's a negative because the banks look at it as, you're someone that's in desperate need of money, and you look to be a financial risk. Someone who opens up a bunch of cards in a row. Again, so you have to take that into account. If you're in the market for a business loan, something to that effect, and yet you see that if you open up 5 cards, you'll be able to get 500,000 points and be able to take your family to Israel for the summer. You got to balance that, right? Either it's between losing 10 points and potentially paying hundreds of thousands of dollars of interest over the length of a mortgage, not being able to get a business loan because your credit is too low, or having those points for the trip to Israel. So again, so by monitoring it and seeing where you're holding, and if you're on the fence in between making it fair and a good score, and opening up 5 cards is going to put you under the limit, you have to be careful that you don't put yourself in a position where you're going to make yourself not bankable down the road. There are instances where opening a new credit will benefit you. And that's, as I said, the big red flag, as I said before, is maxing out your credit limit. So if you have, let's say, as I said before, if you have a $20,000 line of credit, $20,000 credit limit, and you're up to, let's say, $15,000, so you're way over the 40%. So that's a huge red flag, and that's going to lower your credit score by a lot. So in that situation, I would recommend you open up a card or two and transfer the balance. Again, obviously, you're not going to spend more money on those cards. If you're able to take that $15,000 and divide it amongst 3 cards, now all your cards are under the 40% threshold. That's going to open up, that's going to raise your score anywhere from 10 to 20 points, as long as you're under the 40% on each card. Again, so in some cases, it's worth it to be able to, even though, like I said, opening cards is a red flag, but it's worth to be above the 40% threshold. So that's one instance where it's a good thing to have new credit. The last thing is inquiries. The same thing, right? The person has to be very careful. We said every time a person applies for a credit card, there's a hard pull on your report. So someone has to make sure that, don't just say, hey, let me just see if I'm eligible. You know, let me look at it. Maybe I, you know, and if you're not sure that you're going to open it, that you're going to open the, that you're going to open up the card, don't do it. It's going to cost you points on your credit score. And just, you know, so one more tip also, as we said before, in terms of, you know, again, we said the red flag is maxing out your credit report. Right? We said that was a big red flag. Maxing out your credit limit on the card. So if you have, let's say, a 20,000 credit limit, you're at, let's say, 10,000, so you have 50%, you're above the threshold. In a lot of cases, you can call the credit card company and just ask if they could bump up your credit limit. You know, in most cases, they'll do it without a credit check. So if you call them up and say, you know, it's possible to raise me by $5,000 or $10,000, in most cases, they'll be glad to do it as long as you're responsible, you make the monthly payments. And now you automatically put yourself under the 40% threshold. Now you have a 30,000 limit, and you're only at $5,000. So that's, again, something that's going to, by the next cycle, will raise your score by a lot of points. And the last thing is, you know, again, as I said, since the main goal is to maintain an above average credit score, the last thing is sometimes the situation is bad enough that you can't fix it on your own. As I said before, I work with credit card specialists. You can call me. You can, you know, again, someone has bad credit. Again, it might cost some money, but in some cases it could be important. If you're in the market for whatever it is, for a house, for a business loan, for a business, you can't get it. There are credit specialists out there that can remove judgments, remove defaults. They know how to work the system and be able to, you know, fight it for you and be able to give you a good credit, maybe able to give you a healthy credit report. So that's something that, again, like I said, in the long term, in the short term, it's going to cost you money, but that could be the right play for some people. So again, so that's the bottom line. So again, so as we said, so a person that can have debt, it's possible. And the main thing is to be able to remove bad debt. That's for sure. That's something that a person should never have. But a person does have bad debt, monitoring your score, doing it in a way that you remove judgments and collections. You stay under the debt to income ratio. You stay under the 35%. You don't max out your credit limit more than 40%. If you work on that and you keep it manageable, you make the payments on time. In most cases, it's possible to maintain a score of above 7, even with having all this debt, as long as you monitor it correctly, and that makes you financially healthy. It's your future is bright. You'll be able to apply for money and have access to capital. You can do all these things. So that's just a basic overview. Anybody has any questions? I think basically covered everything. And again, everyone, you know, thank you for listening. Everyone can, like I said, reach out to me, 917-755-6470. If anybody has any questions. Someone asked me, to get business loans, do banks look at personal credit? Most of the time, yes, unless you're a really, really established business. That's in business for years. But as I said, someone with a new business or a start or a few years in business doesn't really have a track record, they will definitely look at your personal credit. So it's very important that everyone, as I said, the main thing is keep that manageable and make sure you maintain an above average credit score and do proper financial management. Thank you for listening.